We were accounting for special transactions, special business transactions in our last session. We took up 3 of them. One was an insurance premium paid. Taking the example of a business which is insuring its stock, fixed assets, employees, and a premium is paid periodically to keep in force a policy assuring a lump sum amount either after a certain period of time or on the occurrence or non-occurrence of an event whichever is earlier. So the accounting for insurance premium, where the expenditure is accounted when the premium is paid, and as at the end of the year or on the date of payment, we reverse it. We take a part of the expenditure to an asset account, calling it advance premium or insurance prepaid. That was one example. Then we took up the second case of the distinction between drawings for official purpose, drawings for personal purpose by the proprietor of a business. In either case, cash comes out of the bank. That journal entry does not recognize what the drawing is for. It only shows that cash has been taken from the bank. In order to make a distinction in the business accounting, after that entry is passed, if the drawing is for the personal purpose of the proprietor, he is going to use it for his domestic purposes, then we pass an entry, drawings account debtor. Drawings will take on the nature of a personal account, just like Ram's capital, Ram's drawings account. Drawings account is debited because he is the receiver and cash goes out. That was the second transaction that we had taken up. The third was the case of stock which is lost by fire. Stock which is lost by fire will create a new account called loss of stock by fire account, and the credit goes to purchases account. Since no stock account as such is opened, we route all our transactions in stocks through the purchases and sales account, where purchases is at cost and sales is at cost plus a markup for profit. Loss of stock by fire account debtor to purchases account. That will automatically reduce your stock, because that is what happens in a destruction. Stock is reduced. So we have taken up 3 such cases in our last session. I would like to next take up the treatment for an advance received or an advance paid. Suppose the business is a business manufacturing machinery, and the average cost of one particular machine is about 5 lakhs. And on an average it takes roughly about 3 months to manufacture a piece of the machinery. So every seller of machinery, and I take machinery as an example to illustrate heavy duty equipment, that's all. When you purchase tomatoes, onions, potatoes and chilies, you just pay for it and take the item. But in heavy duty equipments, aircraft, vessels, heavy duty machinery, now I may have to place my order first. It has to be tailor made and then supplied to me 3 months later, 4 months later, 6 months later, whatever. So for heavy duty equipment which are stock in trade, Hindustan Machine Tools, Bemel, BHEL, all these are heavy duty machinery manufacturers. Look at their sales. They might sell hardly about 10 to 20 machineries in a year, or maybe slightly more than that. I might be pessimistic. But ultimately one particular sale transaction will take 3 to 4 months or a longer duration to complete, where the buyer would be required as part of the terms and conditions to pay a certain percentage of advance. So let us say there's a machine which is proposed to be sold by a seller to the buyer, and the business is the buyer or the business is the seller. There arises a question of advance. So let's analyze the advance treatment in case of a sale transaction. a sale transaction with an advance involved. Let us look at it from the point of view of the business. A business proposes to make a sale transaction for which an advance is received. When an advance is received, look at the comparison, the contrast with the normal sales. There cash is received in account of a sale. The journal entry passed as cash account debtor because cash comes in to sales account. Sales being a nominal account is an income. Here the cost of the machinery is 5 lakhs. Thus the sale price of the machinery is 5 lakhs. And let us say about 20%, 1 lakh is taken as an advance. Let us say on February 1st, 1 lakh of advance is received for a machine to be supplied on May 1st. Right? So in that case, when the advance is received on February 1st, let us say the date is 1st of February 2020. On 1st of February 2020, when the advance is received, cash comes in, or it comes in through a check. So either cash account is debited because it comes in, or bank account is debited because the bank is the receiver. So I debit cash account, let us say it is received in cash. Cash account debtor, 1 lakh. What do you credit? It is definitely not sales because it is an advance received. Here you will name the account as advance, to advance for sale, 1 lakh. And give the narration being advance received for sale of whatever the item is. So cash account debtor or bank account debtor to advance for sale. Analyze the nature of the account. Advance for sale is presently a liability. It is an advance received from a customer. Now, on let us say the 1st of May, let us say it takes an average of 3 months, Feb, March, April, and on May 1st the sale materializes. When that sale materializes, we must remember that this advance has been booked, or an advance entry has been passed. So out of the 5 lakhs of the cost, only 4 lakhs would be received on account of the sale. So there, along with the cash of 4 lakhs, this advance would have to be debited, because an advance has now materialized into sale. So on 1st of February 2020, when the advance was received, we had passed the entry cash account debtor to advance for sale. Let me extend it here and try to squeeze in the transaction here itself. On the 1st of May 2020, you receive a cash account debtor 4 lakhs, advance for sale, account debtor 1 lakh, to sales account 5 lakhs. What would be the narration? I don't have space here. The narration would be being sales executed and the amount received as advance earlier adjusted towards sale. So here the case of an advance received in connection with a sale. So first you can't avoid passing the entry on this day because your cash would not tally. It would have come in and the book cash at the end of the year and the physical cash would not agree. There would be a mismatch. So every transaction has to be accounted fully. in order to satisfy the matching concept to disclose profitability, financial position for a particular year, the financial year or the accounting period. So you can't avoid passing this entry. So this entry is passed. Cash account debtor to advance for sale. And remember, I've taken such a date that intervening is 31st March. 31st March 2020 intervenes. So on 31st March 2020, what would be the picture displayed? This advance will appear as a liability, and this cash will appear as an asset in determining the financial position of the business. So an advance collected by the business in connection with the sale to materialize later is presently taken to advance and reversed subsequently when the sale actually happens. Now we may have to take the exact opposite situation where an advance is given in connection with purchasing, let us say a heavy duty machinery or an asset which is to come into the business 3 months later. I am reversing the situation. So when I reverse the situation, advance gets to be paid in connection with a purchase which is to materialize into a purchase subsequently. So now it becomes the exact reverse. An advance collected in connection with a sale is a liability. An advance paid in connection with a purchase is an asset. I take the exactly same dates. 1/2/2020, the business has paid an advance to purchase an asset. When you pay an advance, cash is moving. I take the same figures, 5 lakhs, 20%, 1 lakh. Cash moves out, cash goes out. In the case of an advance, in relation to a material to be purchased. So cash account is to be credited. What you debit is advance for supplies. So here, you will take it as advance for supply. Account debtor 1 lakh to cash account 1 lakh. Being advance paid for purchase of whatever be the asset. And on 1st of May 2020, where 31st March 2020 would interfere or intervene, taking a liability and an asset to complete the matching principle, to ensure that transactions are comprehensively covered with the accounting period. So 31st March would be somewhere in between, and on 1st of May 2020, the purchase actually would happen. I would pay only 4 lakhs. So when you purchase, let us say you're purchasing by paying cash. Again, cash is to be credited. So purchases account debtor to cash account is definitely there. What would you pay as cash account? 4 lakhs. This advance gets reversed to advance for supply 1 lakh. Purchases account debtor 5 lakhs, being accounting for purchase, reversing the advance. I have reversed the advance account, and now the purchase transaction is complete. So you need to understand the accounting treatment for an advance in connection with a sale and the advance in connection with a purchase. So these are two mirror images and the two additional special transactions in account. How do you actually account for them? What account is to be debited? What would be the nature? What is to be credited? What would be the nature? Why the debit or the credit? So this is about the advances. Now, one recent trend that we notice is the concept of a cash back in connection with purchases, which comes subsequently. Let me illustrate the circumstance creating that special accounting transaction. I am traveling by my car and fuel up on the way. I enter a petrol bunk, fill up petrol for, let us say, 1,000 rupees, present my card, debit or credit card, swipe it and pay for this petrol of 1,000. What is the journal entry you would pass? Fuel charges account debtor. Professionally we call it fuel charges. We don't take a petrol account. Fuel charges account debtor to bank account. I get into the bunk, fill up and drive away. 4 days later, 5 days later, 10 days later, when I see my bank account, I will see a credit there, 12 rupees, minor amount, 12 rupees, 15 rupees, 9 rupees, 11 rupees. And if you see the narration for it, you will see it is a credit given by that petroleum company. That's a cash back. Presently in the Indian economy, fuel prices, petrol, diesel, etc., CNG, have been left to market stabilization. So if the price of petrol is subsequently revised and a customer, a purchaser of petroleum products is to be given a benefit, that benefit is transferred to his bank account by way of a cash back as a credit to the account. So 1 week back, I had paid 1,000 rupees to a petroleum company, and today, a week later, I get back, let us say, 12 rupees. What is the nature of this cash back? How do you account for this cash back? One thing is clear, the bank account has to be credited. Sorry, debited. Because the banker receives the credit. So I debit the bank account. Previously when I had purchased fuel, bank was credited. So now when you receive this cash back, you will debit the bank. So bank account debtor. What happens to the credit? Don't open a new account because it is not an income. It is a reduction in expenditure. So credit the expenditure. Last week's entry would get reversed. Fuel account debtor to bank was the entry passed. Now it is bank account debtor to fuel account. So my effective expenditure on account of fuel would be 1,000 rupees minus 12 rupees. The account rectifies itself. It's not that I go back and rectify the old entry. I pass a new entry. That is always the accounting treatment. So I'm just introducing the difference between an income and a reduction in expenditure. The same could be the opposite. That is expenditure and reduction in income. So here, the cashback of 12 rupees is not transferred to a new account as such. It is a resurrection of the old expenditure account. So fuel would be credited. So look at how the accounts will reflect it. The first entry to be passed would be for the expenditure. In my example, it was fuel. It could happen in any other transactions also. I'm just taking the example of fuel. So when the expenditure is made, you pass the entry, fuel expenses, account debtor 1000 to bank account because I've swiped my card, being fuel, office vehicle. And a week later, I get this cash back, as we call it. It's called a cash back offer. So when the cash back comes, this entry gets reversed. The bank account is debited and fuel account is credited with 12 rupees, let us say. So the effective expenditure is 1000 minus 12 on the fuel in respect of that one particular consignment or that particular purchase, being cash back received on fuel. So that's the sixth categorization of a special transaction. So now you know the treatment of loss of stock by fire or any natural disaster, insurance, drawings for personal purpose, advance received in connection with a sale, advance paid in connection with a purchase, and now the cash back. We'll stop with that for the session and continue in the next session where I take up GST complications.